Hey everyone, welcome back to Corporate Decoder, the place where we dive into the confusing world of corporate filings. Today, we're cracking open Ring Energy's latest 10K, their annual report. Get ready because after reading this, you might need your own drilling operation to escape the boredom. Just kidding, this will be fun-ish. Ring Energy, based in Texas, is all about oil and natural gas. They explore, produce, and try to find more of it in the Permian Basin. This report tells us how they did last year, what they're planning, and all the things that could go wrong. First off, a disclaimer. A lot of this report contains forward-looking statements, which basically means Ring is making educated guesses about the future. They warn us that things could go very differently. So don't bet your ranch on anything you read here. There are many important factors that could cause actual results to differ materially from those contemplated. For example, those include the price they get for the oil and gas or whether they can raise money to develop projects. Before we get too deep, let's brush up on our oil and gas lingo. You'll see terms like BO, which means barrel of oil equivalent. Basically, it's a way to measure natural gas and liquids by converting them into the equivalent amount of oil. This helps to get a simple estimate. So 6,000 cubic feet of natural gas equals 1 barrel of oil equivalent. Got it? Good. Let's dive into the good stuff. Ring had a pretty good year, they report. They hit record production levels. In 2024, they averaged 19,648 barrels of oil equivalent per day. This was an overall increase of 9%. They also drilled 44 new operated wells that were a mix of horizontal and vertical wells. Vertical wells are the traditional ones that are straight down, whereas horizontal drilling allows you to go sideways. They also say their borrowing base, how much they can borrow, stayed steady at $600 million. And their total proved reserves, that is the amount of oil and gas they know they can get out of the ground, increased a little, 3%. But there's something else happening. They're planning to buy some new property from a company called Lime Rock. Think of it as buying a used car, but instead of a car, it's oil and gas leases. They will pay about $90 million in cash and over 7 million shares of stock for this acquisition. This deal will expand their operations in the Central Basin platform. Ring also has goals to improve their financial health. This include a plan to improve debt, reduce operating costs, and maintain what they call capital efficiencies. Another plan is to buy additional properties that lower their break-even costs. Who buys all this oil and gas? Well, just 3 customers account for 88% of Ring's revenue. Philips 66 accounts for over 60% of their revenue. If anything happened to that relationship, Ring would be in trouble, although they say they can readily find other purchasers if necessary. Now let's talk about the stuff that keeps executives awake at night: regulations and environmental compliance. The oil and gas industry is heavily regulated, with rules about drilling, production, transportation, and waste disposal. One of those things is that a bunch of optical gas imaging cameras are surveying emissions from oil and natural gas production facilities. All of this costs money, so companies must stay up to date with the most recent regulation, which keeps changing. Climate change is another big concern. The EPA, the government agency, is always coming up with new rules, such as the waste emissions charge on methane from oil and gas facilities, which could affect Ring's bottom line. The Texas Railroad Commission, or RRC, is increasing oversight related to flaring inspections. Then there's the Endangered Species Act, which protects certain species and their habitats. For example, the Dunes sagebrush lizard, which lives in some of the areas where Ring operates. Protecting this lizard and other species could mean more costs for Ring and limits on their activities. Part III of this report incorporates by reference information from the company's proxy statement. A proxy statement is a document a company is required to send to shareholders with information about a shareholder meeting. And it is important to keep in mind that Ring isn't committed to providing a fixed quantity of oil or natural gas under any existing contracts. So, they can respond to changes in demand without being stuck in unfavorable contracts. One more thing to consider. A substantial percentage of Ring's properties are undeveloped, meaning they haven't been drilled yet. So the company requires additional capital to develop such properties. If cash flow from the already producing properties isn't sufficient, they might have to borrow money or issue new stock. What about the numbers? Let's scroll to it and take a look at the financials. Ring brought in about $366 million in revenue, and after all expenses, they landed with a net income of around $67 million. Now, let's compare. There was net income of over $100 million the previous year, so they made less this year, although the numbers do fluctuate year to year. They did manage to generate around $194 million in cash from operations, but also spent around $150 million in investing activities, such as buying up properties. As of March 5, 2025, Ring has almost 200 million outstanding shares of stock. Now let's wrap things up by looking at the possible risks. A big one is debt. They have a significant amount of debt under their credit facility, so any changes in interest rates or a drop in oil and gas prices could cause problems. In addition, their bank borrowing base is subject to semi-annual review and redeterminations. The amount of debt could affect operations by using cash flow to service the debt, increased vulnerability to adverse economic and industry conditions, limit our ability to borrow additional funds, dispose of assets, pay dividends, and make certain investments. They also depend on computers and technology, so cybersecurity is a major concern. A successful attack could disrupt operations, lead to data theft, and cost a lot of money. This makes it super difficult to run their business, keep costs down, and protect the environment. So what's the verdict on Ring Energy? They've got a solid base in the Permian Basin, a place known for its oil and gas. Their plan is to keep producing, pay down debt, and be on the lookout for strategic acquisitions. But some risks may affect them. For example, if they can't get the amount of water they need to drill, their operation and results could be affected. Plus, they also depend on the price of commodities. Overall, Ring Energy is trying to balance growth with financial responsibility in a tough industry. Whether they can pull it off remains to be seen. Thanks for watching. If you found this helpful, give us a like, subscribe, and let me know in the comments what company you want us to decode next.